Ever wonder why the cash in your wallet, or the balance in your Venmo account, actually feels real? It's because it's stable, right? What $100 can buy you today, it can pretty much buy you tomorrow. But in another universe, a parallel digital world called crypto, stability is a luxury. 1 second you could be a millionaire, and the next, you can't even afford a cup of coffee. So, what do? Are the people in this world just supposed to live with constant heart palpitations? No, they want stability, too. And so, in a desperate search for some certainty in this Wild West, a special kind of digital gold was invented. And that is our topic for today, stablecoins. It's a name that sounds a little boring, but it hides a story filled with casinos, pawn shops, and even a spectacular, world-breaking scam. Imagine the crypto world is a giant, 24/7 online arcade. This arcade has all sorts of different tokens, like the famous Bitcoin and Ethereum. These tokens are valuable, but their prices are insanely volatile, just like a roller coaster. You might trade 1 Bitcoin for a car today, and tomorrow, it's only worth enough for a bicycle. For anyone who actually wants to do real business in this arcade, and not just gamble, this is a total nightmare. Merchants need something to measure value, a price anchor. In the real world, we use the US dollar or the euro. So, couldn't this digital arcade just create its own digital dollar? This idea was the starting point for stablecoins, to create a cryptocurrency whose price is locked onto a real-world asset, most commonly, the US dollar at a 1-to-1 ratio. One of your stablecoins should, at all times, be worth exactly $1. It's like copying and pasting the stability of the real world into the digital one. Sounds great, right? But here's the million-dollar question: how do you keep it at $1? To solve this problem, 3 stablecoin players with very different personalities emerged. The first one, let's call him the casino boss. This guy is the richest and the most straightforward. He says, it's simple. You give me 1 real US dollar, and I'll give you one of my casino chips stamped with $1. This chip is the stablecoin, like the famous USDT or USDC. You can use these chips to play all you want in my casino, and whenever you're ready to leave, you can cash in your chip, and I'll give you your real dollar back. This method is the easiest to understand. In theory, as long as the amount of cash in his vault matches the number of chips he's issued, the price of this stablecoin will be rock solid. But the devil is in the details. What if this casino boss isn't being honest? What if he's secretly taking money from the vault to invest, lend out, or even just spend on himself? There might be 10 billion chips circulating outside, but he might only have $8 billion in his vault. If everyone rushed to cash out at once, a bank run the casino would instantly collapse. This is the biggest risk with this type of stablecoin, counterparty risk. You just have to trust that the boss is a good guy. The second one, we'll call him the pawn shop keeper. This guy doesn't take your cash. He says, we are a pure crypto world here, we don't touch fiat money. If you want to borrow $100 worth of my stablecoin, fine. But you have to give me something as collateral. What kind of collateral? Other cryptocurrencies that have volatile prices, like Bitcoin or Ethereum. And, to protect against the price of your collateral dropping, you have to over-collateralize. For example, if you want to borrow $100 worth of stablecoins, you have to lock up $200 worth of Bitcoin first. This deal is written into a smart contract that's completely transparent and can't be tampered with, like an automated pawn shop. If the price of your Bitcoin collateral starts to fall and crosses a certain threshold, the pawn shop will automatically sell your Bitcoin to ensure that the $100 you borrowed is always backed by AG assets. The advantage here is transparency, since everything is verifiable on the blockchain. But the downside is also obvious: it's not very capital efficient, and if the price of Bitcoin suddenly gets cut in half, a flash crash so fast that the pawn shop can't liquidate in time, this stablecoin could collapse too. The third, and by far the craziest, we'll call him the Alchemist. This Alchemist has no dollar reserves, and he doesn't require any collateral from you. He says, we will use magic. We will use code. We will use a sophisticated algorithm to create stability out of thin air. Sounds like a fantasy, doesn't it? Here's how it works. He creates 2 tokens. One is the star of the show, the stablecoin like the former USD, which aims for a $1 price. The other is the sidekick, the balancing token like the former Luna. The whole system works like a seesaw. When the price of the stablecoin goes above $1, say $1.10, it means the coin is in high demand. The system lets you use $1 worth of the balancing token to magically mint 1 new stablecoin. You can then sell that stablecoin for $1.10, making a quick 10-cent profit. This process increases the supply of the stablecoin, pushing its price back down to $1. When the price of the stablecoin falls below $1, say, 90 cents, it means there's a glut in the market. The system lets you buy that cheap stablecoin for 90 cents and then trade it with the system for $1 worth of the balancing token, again making a 10-cent profit. This process burns stablecoins, reducing the supply and pushing the price back up to $1. See how that works? It relies entirely on people's arbitrage-seeking behavior, like an invisible hand, to maintain the price. During calm market conditions, this alchemy looked flawless, like a stroke of financial genius. It didn't need any real-world collateral to create stability out of nothing, and it attracted countless people who poured their life savings into it. However, in May 2022, a perfect storm arrived. When a massive, panic-driven sell-off began, the price of the stablecoin, USD, started to depeg from $1. According to the design, people were supposed to buy the cheap USD and trade it for the Luna token to make a profit. But the panic spread like a plague. Everyone was dumping USD, and nobody dared to be the one to catch the falling knife. This caused the price of USD to fall even further. To try and pull it back up, the system had to mint an astronomical amount of Luna tokens. The supply of Luna exploded, and its price instantly crashed by 99.9%, which then caused the entire market to lose faith in Luna itself. Both ends of the seesaw collapsed at the same time. This was the infamous death spiral. In just a few days, a multi-billion-dollar financial empire vanished into thin air. The life savings of countless people were wiped out in this failed alchemical experiment. The collapse of Terra Luna was a massive wake-up call for the entire crypto world, and it sent a chill down the spines of real-world regulators. Investors began to reevaluate risk. The safest casino boss model fiat-backed became the dominant one again, but people started demanding much stricter audits and more transparency about the reserves. Regulators from the US, the EU, Hong Kong, and elsewhere all accelerated their plans to legislate stablecoins. They realized that even though it's called a coin, its function is much more like a bank or a payment system, and it has to be put inside a regulatory cage before it can cause systemic financial risk. Governments even started asking themselves, instead of letting private companies issue a digital dollar, why don't we issue an official one ourselves? This is the very thinking that led to central bank digital currencies, or CBDCs. Stablecoins, an innovation born in the Wild West, are now being pulled, contested, and reined in by all these powerful forces. So, back to our original question, what is a stablecoin? It's a grand experiment in the wild world of crypto to create stability. It's like a bridge, attempting to connect the chaotic digital world with the orderly real world. There are 3 ways to build this bridge. The first is like a casino, using real cash and gold as its foundation. It's simple and strong, but you have to trust the integrity of the casino boss. The second is like a pawn shop, using other crypto assets as collateral. It's transparent, but it's vulnerable to market earthquakes. The third is like a castle in the sky, built with elegant algorithms. It's beautiful to look at, but it has proven that it can be a mirage. The collapse of Luna taught us that there are no perpetual motion machines and no free lunches in finance. Any attempt to create value and stability out of thin air will eventually come with a painful price tag. So where are stablecoins headed in the future? They will most likely become heavily regulated extensions of the traditional financial system. The opaque, high-risk alchemy projects will probably be weeded out, while the casino bosses, who are willing to embrace regulation and provide full transparency, may become the ultimate winners. This grand experiment in digital stability is far from over. And all of us are witnesses to it.